I wanted to take a few minutes to demonstrate a real life portfolio and just to show you things that I was looking for and hopefully you'll be looking for when you're setting up your portfolio, at least right now when you're relatively young. And I may have mentioned that my daughters inherited some money a few years ago, and I convinced both of them to just forget about that money and let me invest it for them and serve as the start of their retirement account. And both of them were in their teens, so I viewed them as being extremely young and able to handle a fair amount of risk. So the portfolio I created for them is not extraordinarily risky, but it is perhaps more aggressive than I would suggest ever for me because I'm 50 years old and I don't have nearly as many years to recover from a tremendous drop in the stock market compared to my children. So these are the four index mutual funds that I bought for them. And this particular one is a US based index. Most of the companies in there are larger firms. And that's just the nature of the US stock market. But I didn't want their portfolios to only have big companies in it, and I didn't want it to just have US companies in it. I did want it to be all equity, all stocks. So there are no bonds, no debt securities in any of these four funds that I chose for them because they are so young. I think they would benefit more from taking the risk of equity investing and potentially earning those high returns versus the lower, more stable returns of debt investing. So, this one, all US, relatively large companies. It does have some small ones in it, but not that many. And because I wanted them to both have some smaller companies in their portfolio, because the smaller companies, as I've shown you in class or online through the lectures, smaller companies tend to earn higher returns, but they are quite a bit riskier than larger companies. But I wanted them to have some smaller companies, so I popped in this small cap investor fund from Vanguard. And I put 22% of their portfolio in that. And you might say, wow, that is a lot. But just wait. These two both are full of US based companies. And I didn't want their portfolio to be solely US based companies. So I added this particular fund, which is another index fund. And it is investing in stocks all over the world except the United States. So, because I have all my US stocks in these two funds. This one is a non US stock fund, but it's mostly bigger companies. So, I added a fourth fund that is all non US, but they're small cap companies. And again, I put 22% of their portfolio in there. So, if you look at these two small cap funds together, they're 44% of my kids' portfolios. And that's a big amount to have in small cap. It's really aggressive. But as you will see when we do what's called an x-ray of our portfolio, it's really not as heavily weighted in small caps as it might seem from these numbers. Just because this fund is labeled or entitled small cap index investor, that doesn't mean 100% of the companies in that fund are small caps. They're actually not, and I'll show you in a minute. For a little bit more information, let's see. I also tracked their expense ratios. This is basically the amount of return that I give to the fund every year for managing my or choosing the stocks that they invest in these particular funds and choosing when to add more stocks, when to sell some stocks, what have you. But looking at the turnover, I can see they don't do a lot of trading. And I don't want them to. These funds basically, for the most part, buy and hold securities, and they're not actively managed, they're passively managed, and so their turnover ratios are relatively low. Allows them to help keep their expense ratios low. And and you'll notice there's a fair amount of variability among the four funds as to their expense ratio. This has the lowest. This is excuse me, It's it's a little more difficult to find information on small cap companies. Small cap companies, if they do really well, their prices will go up. And since market cap is determined by price times number of shares, as the price goes up, a small cap company last year might not be a small cap company this year. It might grow up to become a mid cap or a large cap or even a giant cap. But a lot of good things would have to happen for it to switch from small to giant in a year. Um, so, since this particular fund wants to mostly invest in small caps, as small cap companies grow and aren't small caps anymore, they have to do some more trading than the first fund. And you'll see their turnover is quite a bit more than that first fund, which is a large or bigger, well, it's a fund that invests in larger cap stocks, just because that's the nature of the US stock market. And it's also more difficult to obtain information on foreign securities. And you'll be trading on foreign exchanges. You won't be, but the fund will be. And that costs more. Foreign exchanges aren't necessarily more efficient. These funds also have to deal with exchange rate fluctuations and stuff like that. Managing these types of funds, even though these are passively managed funds, managing them are a little more difficult than managing a US based fund, so you'll notice their fees are higher, but they're still relatively low. The average expense ratio for an actively managed fund is about 1.4%. So you can see these ratios are much, much lower. And then, just as a point of interest, I looked up how many securities each of these funds owns. The US the total stock market index investor fund that's based in the US has almost 4,000 stocks in that one fund. And you can see the number of stocks in the other funds. So by owning these four funds, my kids have indirect ownership to about 11,000 different companies, equity in those 11,000 different companies. So if 100 of those companies go bankrupt, that's really not that big of a deal. There's still, 10,900 other companies out there that aren't going bankrupt. But if they only had 10 stocks in their portfolio and let's say two of them bankrupt, that's going to be a huge hit to their portfolio. Then, just for the sake of interest, I collected data on their returns for the past decades, not decade. I tried to get the data for the past decade, but a couple of those funds have not been around more than 5 or 6 years. So I only went back the past 5 years. And you can see that, like in 2010, the small cap US fund did well. That's this one. It's not specifically got the title US in its name, but it is mostly just US funds. During 2011, it wasn't a good year, but the US stock market did okay, whereas the foreign markets did not. In 2012, they all did about the same. In 2013, US markets did well, foreign markets did not, even though foreign markets didn't do badly. And then in 2014, again, US markets did well, but foreign markets did not. That doesn't, I mean, I know there's a few years now where US markets have done well and foreign ones haven't, but that doesn't mean it's always the case. Um, and what I want to do next, I want to show you this, but it's really sort of a precursor to chapter 17, which is on rebalancing. But what I'd like to do is just tally how much their portfolios have grown over the past 5 years and look at the weighting schemes. These are the weighting schemes that I set when I first formed their portfolios for them. And they're kind of odd because Vanguard has a rule that you need a minimum of $3,000 to invest in one of their funds for the very first time. So when I opened their account, I needed to start it with at least $12,000 because I wanted to put at least 3,000 in each of I had to put at least 3,000 in each of those four funds. And I could have just opened it with 3,000 and bought only one fund, but A, they inherited more than $3,000, and B, I wanted to diversify their portfolio. So they inherited about 14,000. I put enough in there to make it get up to 14, so they would have an even number. But like if I really didn't want 22%, I really only wanted 20, but when I make it 20% of 14,000, I get less than $3,000 here. So I had to up these percentages just a tad more than I wanted to, but that's okay. So, um, what I want to do is track like how did their investment in the total US stock market, so VTSMX, do during 2010. Well, they started that year with 4,760 in it, and it earned 17.09%. So basically, I'm going to use the future value equation, but I'm going to just type it out rather than using interest factor tables. So it would be times 1 plus this rate, but this rate needs to be a decimal. So I need to, right now it's 17.09%, but I need to divide it by 100 to convert it to a decimal. So the 4760 grew to 5573. If I just copy that down, that should adjust for everything. And then I'm just going to sum these four so I can tally how the 14,000 is doing. So in 2010, it did pretty good. And then the second year, my starting amounts aren't these values anymore. My starting amounts are these values. So I need to base my formula off of these values. So in 2011, her investment in VTSMX was now 5573, and it earned only 0.96%, which I have to convert to a decimal. And that should work. So it grew, but only by, $50 or whatever. And then I should be able to copy that. Oops. Copy that down and just copy this over so I can track how things are going. And her investment in the non US small caps dropped by almost 20%. So her 3,849 fell to 3,114. I'm just going to click on that, look at the formula, make sure it's referencing the right cells, which it is. So her investment of nearly 17,000 fell to 15 and a half. But I should now be able to just copy all these across, and we can see that her $14,000 investment is now worth about $24,000 over a period of 5 years. So let's calculate what rate she has earned, and this rate will be the compound annual return. I'm just going to use Excel's built-in time value of money features to figure it out. So it was a 5-year time period, no payment. The present value was that 14,000, and I have to enter it as a negative. And the future value is this 24,432. So there is her average annual rate of return, average compound annual rate of return, nearly 12%. Now that's pretty high. It was volatile. There was 1 year of the last 5 where she lost money. And then just to allude to something that we're going to talk about in chapter 17, if, and this is a big if, it's really never going to happen. If each of these securities earn, each of these funds, mutual funds, earn the same amount every single year, then at the end of the 5 years, these numbers would equate to the same weights. So my ending weights would be the same as my starting weights. And these starting weights were chosen. Decided how much I wanted to put in small caps versus large caps. I decided how much I wanted to put in foreign securities versus domestic securities. So I didn't just randomly generate these weights. I like this weighting scheme and I'd like to keep it. Well, if I do nothing, it's not going to stay at that weighting scheme. So what I want to do is just show you how the weighting scheme has changed. And you can see, like, remember I mentioned how the US markets have done better than foreign markets for the last couple of years? Much better in 2013. That's boosting the weight of US markets. And they actually did better this year, I mean, during 2011 as well. So what we're going to see is the weight of foreign securities as a proportion of the total has dropped quite a bit. To figure out that weight, I just take this ending value in this particular fund and divide it by the total. And this is a percentage, so I need to format it as that. And I'm going to go ahead and pop that down so you'll see that's 100% down there. And just for comparison, I will, I'm going to just highlight these. It's really these, well, that didn't work very well. It's really these sets of numbers that I'd like to compare. So these two are US markets. They're now nearly 70%. Non-US is about 30%, whereas before, initially they were 56% and 44%. So just like I said, the non-US markets are much have a much lower weight than they originally did. So what I need to do periodically, more often than every 5 years, is what's called rebalance. And that's the subject of chapter 17. So I'll show you that then. And I'll probably use this exact same spreadsheet unless I forget about it by the time I get to chapter 17. But I also want to show you the Morningstar X-ray. If you go to this website, and I'll create a link to it in the module, and you enter your ticker symbols. So I would input the where are they? I would input these four ticker symbols, and I would input this amount because that's how much I invested in each of those when I first formed this portfolio for my kids. So I would pop that information here. And as you type in the information about you can do individual stocks here, or you can do ETFs, you can do mutual funds. But as you type in the information, it'll tally the total value of your portfolio. And when you press Show Instant X-ray, it will pop this up for you based on the stocks and mutual funds and ETFs that you inputted in that table. And so this is an aggregate of my daughter's portfolio. Unfortunately, to access these, you need a paid account. And I don't have a paid account on Morningstar, but the overview is free. So, what does the overview tell me? It breaks down the portfolio not just of one of those funds, but all four of those funds based on how I weighted them because it knows what my weights are because I told it how much I spent buying each of those four. So it breaks the whole portfolio down by US stocks and foreign stocks and by bonds if I had any, which I don't, or my daughters don't. So you can see it's not quite a half and half split, but it's mostly US stocks, but a large amount of foreign stocks. And I was kind of I was aiming for that, about half and half. It also analyzes the equity portfolio. This interest rate sensitivity is related only to bonds, and since I don't have any, it's not put anything there. But for my equity portion, it creates what they call a style matrix. And what I am looking for is balance, but I don't want it to be too heavily weighted in small caps because small caps are so risky. I don't want a half of my kids' portfolio in small caps. That's too risky, I think. But and so if I sum these, and what these numbers represent are the percentages of her whole portfolio that's invested in small caps. So 9% are in small cap value stocks, 8% in small cap core, and 7% in small cap growth. And if I sum that, that gives me what? 24, 25, nope, 24. So 24% of my daughter's portfolio is in small caps. And remember, I said it looked like I had actually 44% in small caps because both of these funds are small caps. But I said just wait because it's not really 44%. It's a lot less than 44%. It's only 25. But 25% in small caps is still pretty aggressive. I don't want you to think 25% is perfect for you. I can't tell you what's perfect for you because I'm not you and I don't know how willing you are to take risk. And what, 32% is in mid cap companies, and the rest, what's 44%, is in large cap companies. So you can see the bulk of her portfolio is large caps, but it's got a decent amount of small caps in it. And down here, it breaks it down by different regions of the world. So most of them are in North America. The next biggest, gosh, what's the word I'm looking for, segment is in the developed European markets, but I've got some money in other regions as well, and also some in the very risky emerging market. So here's the Asian emerging market, 4% is in that. The Europe emerging market, 0.38% is in that, and then I would classify Africa and the Middle East as emerging as well. So I've got about 5% of their portfolios in emerging markets. And to me, that's enough. Emerging markets are risky, small caps are risky. I've already created a fairly risky equity portfolio for them, and I don't want it to be to have what I think is just too much risk for them. And then it also tallies how much I will pay in mutual fund fees essentially per year based on the current value of my portfolio. So it knows that I invested 14,000 based on the expense ratios that these funds charge. Here's the annual fee that I will pay for for having those funds manage my portfolio for me. Now they're not telling me here's the weight you should put in each of these funds. I have to decide that myself. But what they're doing is actually managing this fund. And another person is managing this fund and this fund and this fund. And that $35 or $34 or whatever it was, that's the amount I'm paying in total for this year to have those funds managed. And to me, that's a decent amount given it's a $14,000 investment. If it were only a $100 investment and I had to pay a $35 fee, well, I wouldn't like that at all. So the Morningstar X-ray gives you a nice overview of the combined securities and funds in your portfolio. It also, and I failed to mention it, it also breaks it down by sector. And if you look, you can see that 42% of their portfolio is in the cyclical sector, which is quite a bit more than this comparison. But I want to point out this comparison is for the S&P 500, which is a US based stock market index, and about half of their securities are in foreign stocks. So I wasn't trying to get these two columns to be equal. I'm looking for the technology sector. Interestingly enough, the technology sector is a little bit underweighted. The sensitive, broad sensitive super sector, they call it, is a little underweighted compared to the US market. But again, that wasn't my goal. But if you're just curious to know how it's allocated by sector, it does provide you with that information.